And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani, and I am very happy to be back at the New York Stock Exchange, where I have been for 24 years. It's a big day for all of us at CNBC to be back here. Two of the best in the business with us, as we always have the best in the business on ETF Edge. Our guest today, importantly, John Hoffman, head of ETFs and Index Strategy Americas at Invesco, and Doug Yonis, the head of ETFs at the New York Stock Exchange, right here on my left, your camera right. Doug, I want to start with you. If 2020 was the big year for bond ETF inflows, 2021 seems the big year for equity, particularly plain vanilla S&P 500 type inflows into equities, really large this year. What's driving these inflow, and what other trends are you seeing? Give us a 30,000-foot view.
Yeah, it's been really interesting. The growth rate of ETFs just hasn't slowed down all through the pandemic. And as you mentioned, last year really focused on fixed income. This year, $331 billion coming into ETFs. Majority, almost 80%, equity ETFs. There's a few themes that are still running out there. First and foremost is adoption rates. BBH, Brown Brothers Harriman, they put out an interesting report showing investor adoption of ETFs across almost every segment. And what's really fascinating to me, it's not just you and me as retail buying ETFs now. Advisors are more and more showing ETFs to their clients and putting them in portfolios. Institutions more and more adopting ETFs, and it's because the wrapper offers efficiency, tends to be a little lower cost, tends to be a much higher tax efficiency. Second key thing that I'm seeing, Bob, is active. Active ETFs continue to grow. Over 100 different active issuers now on the market, over 500 active ETFs now, 70 some launched already year to date. As if you're an active manager, historically you might not have been interested in ETFs. You'd have to show your holdings every day. That's now changed. We've got models that can fix that. So a lot of active adoption. And third is this sort of holy grail of ETFs, conversion direct from mutual funds to ETFs. Guinness Atkinson did it first in March. Today, second ever time it's happened ever. Adaptive worked with Nottingham as a platform, and they converted a mutual fund, 150 million converted today to the New York Stock Exchange in an ETF, AGOX. So there's a lot of these really interesting moving parts, all of which are bringing together a lot of cash flow into the industry.
I want to talk more about sort of the plumbing and the ETF trends, but John, I want to turn to you and get your thoughts on sort of sector and individual ETF moves, because you're one of the biggest providers out there. What I saw, John, was the slowdown in green energy in 2021, and I wonder if you can just sort of talk to us about that a little bit and what you are starting to see here. You run two of the biggest clean energy ETFs that are out there, the Solar Energy ETF, TAN, and the broader fund, the Green Energy Index, PBW. Both of them are 40% off of their highs that, interestingly, they hit in February as interest rates hit new highs. Can you just tell us, this was such a hot trend last year, and CNBC viewers love investing in thematic tech and clean energy. 40% off their highs is quite notable. What's stalling clean energy out right now?
Yeah, Bob, I think let's widen out the lens a little bit here, and let's go back to last year. During the election, leading up to the election, flows started to really pick up in the space. In 2020, both of those funds were up over 200%. And when you think about the transformation to clean energy, we think about it over decades, not days. And so, again, Bob, I joke that after 15 years, this is an overnight success story in the space in sustainable and clean energy. You go back to the early days when we launched these funds, it was a new sector, a new space, a lot of new companies. It's still a relatively new space, so you're going to see some of that volatility that you're pointing out. But when you, again, widen out the lens and look at the big picture here, the move to sustainability, the move to clean energy, again, it's not just a U.S. thing. It's a global phenomenon. Yeah. And the money that's moving into the space is going to be significant. And so, again, a little bit of a pullback here. But when you widen it out and look at the trends, and again, it's still a small market. We were looking at the market cap of all of the names in PBW, the Clean Energy Fund. Again, exclude Tesla. Add up the market cap of all of those names, and you get to a company about the size of Johnson & Johnson. And so we think there's still a fair amount of headroom in the space, especially as this transformation to clean energy plays out, again, driven by regulation.
I can't help, John, but think that a lot of this reason it topped out was at the same time that interest rates topped out in mid-February. A lot of these companies don't necessarily make a lot of money, and I think that certainly was an aspect in it. But it hasn't prevented people from launching new ETFs, particularly green ETFs. You've got a green building ETF, symbol GBLD, you launched just a month ago. What's in that, very briefly?
Yeah, so again, we pioneered this space of thematics. We continue to provide more precise ways to get exposure to the space. And so this is about, look, this conversation on decarbonization, you can't have it without looking at the real estate sector. 38% of the carbon emissions come from buildings. And so this is really about providing investors a precise way to invest in the real estate sector as it relates to cleaner and greener buildings. And so this is the full ecosystem of green buildings, every stage, construction, redevelopment, retrofitting. Bob, it's a continuation of the same theme here.
You can't help but think, Doug, that this was the hottest thing in 2020. It's cooled off a little bit. I think he's right about the long term, but you know, it's tough when you're 40% off of the highs.
It is, but at the same time, I mean, John's breaking new ground, whether it's the green building ETF or other ESG-related ETFs. I mean, there's now almost 100 ETFs here in the U.S. Europe's really dominated the ETF space in ESG investing, but we're catching up, and we've got $11 billion in investments coming into these thematic, if you will, ETFs here in the U.S., and it is a combination of conversation. I think, John, you're absolutely right. Some of the advisor conversation now is, should this be part of my core and not just thematic? And I think we're starting to see that again. Some of the response rates and surveys, some of the conversations we're having at the exchange, our investors are starting to take a little bit of a tilt. You know, BlackRock joined the fray, if you will, earlier this year. They launched 2 ESG ETFs and actually broke the record on first day assets under management. So more and more investors are really turning on to the idea of, hey, maybe this is my core portfolio and not just a thematic or a satellite.
Another thing that I've noticed, John, is the reflation trade is very much in evidence, particularly commodities. You've got a commodity index tracking fund. The symbol is PDBC, Peter, Dog, Boy, Charlie. That's a basket of commodity futures contracts that, of course, rolls over. Big inflows, I see, outperforming the S&P 500 this year. Tell us about what kind of people are buying these commodity funds, and how do you protect against that negative roll? We all know about that problem with owning futures contracts, particularly commodity futures contracts with that negative roll.
Yeah, thanks, Bob. So first of all, address the roll topic. This strategy actually uses a smart roll technology. It looks at the curve of each of the underlying commodities and finds the most optimal place on the curve to roll. And so it is seeking to get ahead of issues around contango and backwardization. But let's back up a second here. A number of analysts think we are entering a new super cycle in commodities. Again, we're not sure about that. But when you look at the inflation, the commodity fundamentals, the discussion around that, what's happening from the administration as it relates to infrastructure, clean energy spending, electric vehicles, this is what's prompting these client conversations. How do I participate in these movements? And so at Invesco, as you point out, Bob, we pioneered that space with commodity ETFs, broad exposure. This particular fund has doubled from $2.7 billion to $5.4 billion just this year, since January of this year. Again, a simple way to get broad exposure to your metals, your ags, your energy in a single solution with a smart roll technology built into it.
And yet commodities as an asset class, we've recognized commodities as an asset class for decades. And yet, given what's been happening in the last 10, 15 years, nobody owns them. It's hard to tell anybody, you should own 5% of your portfolio in a commodity ETF even, just like it became hard to argue about having gold. It's a tough call, and yet that would have been the smart call.
It is interesting, right? There's an academic science here that does show having commodities as part of a portfolio does reduce overall volatility of a portfolio, but you're right, usually that's played out in the form of gold. Nothing wrong with that. Gold's performed really well over the last few years and maybe even decade if you start to chart it out longer term. But at the same time, we look at commodity flows this year, Bob, and what do we see? Year to date, almost $10 billion leaving gold ETFs. But what I think what John and team are doing, right, is they're starting to say, hey, maybe we look at commodities at a broader lens. Maybe we take a step back. And John's team putting together multiple commodities in one place. Historically, really hard to access that market. You'd have to be trading your own futures, become, almost a sophisticated institution. What's great about ETFs is they're now bringing that and democratizing that space and bringing commodities, futures. They're able to put a nice clean wrapper on it, bring it to an end investor.
I agree.
Yeah,
diversification is really a key to success in any portfolio. It's hard to argue about what you should buy in commodities, but a simple strategy would buy a broad, diverse commodity fund like this one that holds it. John, you were making a point?
I was going to say, yeah, and even going back to why the flows are so strong, it's about providing the technology, providing very efficient exposure to this return pattern. In this instance, we're talking about commodities, which have low correlation to equities and bonds. And so when you think about building, Bob, to your point, a diverse portfolio, having an allocation to commodities, we've seen a number of large institutions keep that as a strategic allocation long term, not trying to time it, but the benefit of that diversification. And your question around who's buying this, and Doug's point, it's individual investors, it's retail, it's wealth managers, and it's some of the largest institutions in the world getting this highly efficient return pattern delivered through the ETF. And so I think all very valid comments there.
Yeah. I want to move on and talk about one interesting trend, of course, is the move into plain vanilla ETFs, equity ETFs like the SPY. But at the same time, I notice, John, your equal weight ETF, the RSP, which is very popular out there, has attracted a lot of inflows. In fact, the assets under management, the shares outstanding are 30% higher in the last 5 months. That's quite a move for such a big fund. Of course, the RSP equally weights the S&P 500 as opposed to the market capitalization weighted S&P funds, which are far and away the more prevalent one. John, why is equal weight suddenly more attractive to some class of investors? Obviously has been very interested in putting money to work in that space in the last 4 or 5 months.
It has. And Bob, look, I'd use an analogy here. When you go to the doctor and they're checking you, they look at your vital signs, your temperature, your pulse, your blood pressure. They listen to your breathing. They get a quick gauge on your health. Starting about 8 months ago, we started to hear from clients that they were concerned with some of the vital signs on these large market cap weighted indices. And it was around two things: concentration and valuation. The big tech names have, gotten even bigger. They're dominating the indices. In some cases, they were up over 25%. The top 10 names were making up 25% of the cap-weighted exposure. And so you've got to go back to 1975 to find that level of concentration. And even then, it was more diverse. It wasn't highly concentrated in technology. So, Bob, we had a lot of clients come to us looking to get a more balanced approach. They wanted to stay in U.S. equities, but they wanted a more balanced approach. Top 10 names in this, 2.5%, not 25%. Yeah. So a more balanced approach to the market, and that's what was driving a lot of those flows over the last period. Bob, I'd mention, though, it's not just a recent phenomenon. This fund goes back to 2003. Had you invested $1 in the equal weight S&P 500 in 2003, you'd have $6.7 today versus 5.4 in cap weighted. So it's a trend that is relevant now, but it's been important for a while.
Yeah, it's a close call. If you, from a classic investor perspective, I'm a Jack Bogle disciple, Burton Malkiel guy, so you want to have broad diversification, of course. The question is, does equal weight give you truly broad diversification? A traditional guy might say, well, market cap exists for a reason, because bigger companies have a more important weight, and therefore they should have a bigger weight. It's a tough argument, but I get the whole equal weight idea.
It does, and my background, of course, having lived and breathed the market cap weighted world for most of my history. But there's also a conversation to be had, right, of, well, if I'm overweight, maybe as my core portfolio in market cap weight, and I start to believe in mid-cap or small cap, do I have to go pure mid-cap, pure small cap, or can I take something like an RSP or an equal weight and actually add it to the portfolio and give me exposure to new places? So even someone who's a purist on the market cap weighting can still look at something like an equal weight and say, hey, is this an interesting way to start to add other parts of the investment experience or the other parts of the mid and small cap market at a different weight than maybe going pure? So it is an interesting blend, and it all comes down to, look, ETFs ETFs give us this option. ETFs give us a nice, easy way to do this versus going out and buying hundreds of stocks and having to cross bid-ask spreads, et cetera.
The old school guys would say, look, you certainly have 5 stocks or 20% of the S&P. Okay, you're right. Yes, there's all these other things like energy and banks that have underperformed for a long time, and you haven't done anything with that. But now we see value outperforming. We see energy doing better. We see banks doing better. And so those guys, if you're a market cap weighted guy, you're now getting the benefit of those that move up in value and energy, and tech is moving down. So the market's rotating, but you own the S&P 500, so you're in good shape. That's the old argument of the market cap weighted guys, and I get it. But this is a fascinating discussion about equal weight. But I want to move on, John. Leisure and entertainment. I want to talk a little bit about the reopening story here. PEJ, you have one of the big ones in this space, and this sort of buys stuff that's right across the whole leisure and entertainment space. So you own Disney, you own Chipotle, and this thing. You own Airbnb at the same time. Yet it topped out in early March. Have we pushed the reopening trade about as far as we can right now? Is all the optimism now essentially in the reopening and the entertainment? Everybody's going to go out and have a good time trade.
Yeah, look, this was a fund that we launched over 15 years ago. It sat at very low capital for a long period of time. Actually, about a year ago, it was $50 million. It ended 2020 at $700 million. It's $1.6 billion now. So it was a way the clients looked at to position for this reopening trade, if you will. And to your point, Bob, there was not a lot of leisure and entertainment during the pandemic. These names, were beaten up pretty good during the pandemic. But to your point, you've got a basket here of 32 companies focused in the leisure and entertainment, names that have been benefiting from the reopening trade. And we continue to see clients add capital to the portfolio. Again, a precise way to get exposure to these names that have been beaten up so hard.
I can't help but think, how much more optimism. We had a joke for the last few weeks, peak everything. It's basically the earnings are just blowout. They're 20% above what the analysts thought. They've been wrong again. They're bringing up second quarter and third quarter earnings numbers. The economic data up until a few days ago has been killing it. Much better than anticipated. So this thing evolved sort of like peak everything. Like, how much better could it possibly get? We now know about the reopening story. We all know there's going to be a giant party of sorts this summer because everyone's going to want to get out.
Yeah, I mean, we talk about that excitement, but even you and I, right, walking in the building this morning, felt amazing, right?
Yeah.
Seeing each other, being a part of it, how great is it going to be to experience some of that and actually go out and attend these things and go be a part of the opening economy? So a lot of it has been focused on it's coming, but a lot of it hasn't really been focused on we're actually going and doing it. And so I think there is a bit of a natural excitement about bringing people back together and then going out and actually being able to do these things. And so maybe that parlays into the next level of growth.
Yeah, well, I'm very excited about being back myself. The New York Stock Exchange is sort of emblematic, I say, of what's happening around the rest of the country. It's been open, closed in March, opened in May, and it's been open ever since. But it's been on a fairly small staffing level. You've been doing a lot of work from home, everybody else, but now everybody's slowly coming back in. And I think the NYSE is being a leader in that. And slowly but surely, more people are going to go back to work over the summer. Some people, there'll be more work from home. But I'm a good example. Here I am. I'm back. We've got to show some leadership, you and me, and be back to work with people. So I'm delighted to be back, and I think it's going to be a wonderful summer. I'm very excited to be back here at the New York Stock Exchange. We're going to have to leave it here. My thanks, of course, to John and Doug. I've asked Doug to stay for a few minutes to chat about a little more on the ETF business for our Insight or ETF Edge podcast. But remember, you can see all of our shows etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.